Hey Lux Invest fam, welcome back to part 1 of our investigative series, How the Finance Industry Destroys Us. We're crossing a terrifying milestone. Total U.S. household debt has surged past $18.2 trillion. That's an extra $4.6 trillion added since 2019. Every month we're being drained of our potential and our sanity by a system engineered for extraction. Let's talk about the silent killer in your wallet. Credit card debt is at $1.21 trillion with an average interest rate of 24.35%. In 2026, we're seeing a delinquency divide. In lower income zip codes, over 14% of cardholders are falling behind while the system profits. In 2026, we're also facing a new challenge: inflation-linked debt. As basic costs, groceries, utilities rise, families put survival on high-interest cards. This creates a lethal spiral. You aren't just paying for what you bought, you're paying a 25% premium on your very survival. It's designed to keep you on a minimum payment treadmill. If you owe $5,000 and only pay the minimum, you'll be paying for decades. You end up handing over 3 times what you borrowed. It's not a service, it's a tax on being alive. But it's not just cards. The predators have evolved. Have you heard of Rent Now, Pay Later? It's the latest repackaged payday loan. It targets renters who can't keep up with skyrocketing costs, adding thousands in fees to your already unaffordable rent. Then there's earned wage access. Marketed as liquidity, it often functions as high-cost credit that leads to constant overdrafts. If you're caught in a payday trap, there are alternatives. Community credit unions offer PALs with capped interest and longer terms. These are designed to help you break the cycle of rolling over debt. The industry wants you to feel alone, but resources exist. And while you're struggling, private equity is busy gutting the industries you rely on, from your accounting firm to your doctor's office. Practices get rolled up into platforms optimized for growth, not care. They strip the value and leave you with higher bills and fewer options. Student loans are back with a vengeance. Delinquency rates for those 90 days past due have hit 8% after payments resumed. By July 2026, Grad Plus loans will be eliminated for new students, pushing many into the hands of private lenders with even fewer protections. The gap between 40-year-olds holding nearly $5 trillion in debt and the younger generation is widening into a canyon. But awareness is the first step. When you're ready to fight back, you need a strategy. There are 2 main weapons in the debt payoff arsenal. The debt snowball focuses on psychological wins, paying off the smallest balance first to build momentum and keep you motivated. The avalanche is mathematically superior, targeting the highest interest rate first to save the most money over time and cut your debt life sentence. We also have to acknowledge who the system hits the hardest. Data shows predatory lenders disproportionately target low-income and minority communities. They face higher rates even when credit scores are identical. Dismantling this predatory architecture is essential for closing the wealth gap. Finally, we have to stop the cycle before it starts. In 2026, banks are marketing teen credit with high-interest hooks hidden in gamified apps. We need to teach the next generation how interest works and how to spot a trap. If we don't educate them, the industry will. Teach them the power of compounding growth instead of compounding debt. Awareness today is their freedom tomorrow. The tide is turning. California is capping overdraft fees at $14, and New York is allowing its attorney general to prosecute abusive practices directly. Audit your debt, every balance, every rate. Negotiate. Many banks will drop your rates if you threaten to walk. Take control. Use free tools like undebt.it or AI-powered trackers to map your escape. Don't let them win by being silent. Before we go, there's one more layer. In part 2, we're exposing the black box, the secret algorithms that banks use to score your worthiness. They decide your financial future before you even apply. We're going to show you how they work. This is just the beginning of our deep dive. Subscribe, share this with someone trapped in the cycle, and let's take back our financial power. I'm the Lux Invest Guide, and I'll see you in the next one. The quiet killer, hidden fees, overdraft charges, and the sneaky extraction machine that drains your account without you even noticing. It's an invisible tax on your survival. Banks and fintechs aren't just holding your money, they're mining it for billions in junk fees every year, turning your financial slips into their massive profits. In 2026, the situation has escalated. After brief regulatory attempts to cap fees in 2024, a massive lobbyist push in 2025 essentially reset the clock. The industry fought back hard. Oversight was weakened, and the consumer protections we thought were secure were quietly dismantled behind closed doors. The results were immediate. Overdraft and non-sufficient funds revenue jumped for the biggest players, hitting record levels in early 2026. Overdraft fees now average $35, but it's the frequency that's lethal. Banks can hit you multiple times a day for the same underlying issue. Some institutions even use transaction reordering, processing your largest payments first to empty your account faster and trigger more individual fees. A gallon of milk or a tank of gas can suddenly cost you $40 once the bank's convenience fee is applied to the transaction. If you can't pay it back immediately, sustained overdraft fees kick in, a daily penalty just for being broke. It's a debt spiral designed to be inescapable. But the extraction doesn't stop at overdrafts. It's a multi-layered system of gotcha charges that permeate every aspect of modern banking. Take free checking accounts. They often come with $25 monthly maintenance fees if you don't meet strict minimum balances or direct deposit rules. Out-of-network ATM fees are a form of double dipping. The machine owner charges you, and then your own bank charges you for the privilege of using it. Wire transfer fees can reach $50. Even transferring money from your own savings account too many times can trigger excessive transaction penalties. This is effectively a poverty tax. The people who can least afford these fees, those living paycheck to paycheck, are the ones who pay the most. While families choose between groceries and bank fees, the biggest banks in the country post record-shattering profits and bonuses for their executives. The digital age was supposed to make banking more transparent, but it's often used to make extraction even more efficient and less noticeable. Banking apps are designed with the same psychological tricks as social media, alerts that encourage spending but go silent right before you hit zero. Fintech products like Buy Now, Pay Later push you into instant debt with hidden interest rates and late fees that would make a loan shark blush. And when you're a victim of fraud, the nightmare doesn't end with the loss. The fees associated with unauthorized payments often pile on before the bank even investigates. In 2026, deepfake voice and video scams impersonate bank officials perfectly, tricking you into compromising your own account and triggering a cascade of fees. This isn't just a personal finance issue. It's a systemic engine of inequality that drains wealth from the most vulnerable communities. While the wealthy benefit from fee-waived premium accounts and investment rewards, the working class is kept in a cycle of constant extraction. Regulators try to intervene, but with billions at stake, the financial lobby ensures that every new rule is met with 1,000 new loopholes. In many other developed nations, these types of predatory junk fees are either capped or illegal. Why are we the outlier? The system is designed to keep you down, but you have the power to break the cycle. It starts with one decisive move. Step 1. Fire your bank. Switch to fee-free institutions like Ally, Capital One, Chime, or SoFi that have built their business models without predatory fees. Or join a local credit union. These member-owned nonprofits often provide the most transparent and consumer-friendly terms available. Step 2. Automate your defense. Set low balance alerts and opt out of overdraft protection entirely to prevent the bank from helping you into debt. Step 3. Audit and contest. Review your statements every single month. Search for the words fee or charge and demand a waiver. Banks are often willing to waive a first-time fee just to keep your business. Be firm, be persistent, and don't take no for an answer. Step 4. Build your emergency fund. Even a small cushion can act as a shield, preventing the initial overdraft that triggers the entire extraction machine. When you stop the leak of hidden fees, you reclaim the capital needed to actually build wealth and secure your family's future. Stop being a source of passive income for billionaires. Stop the extraction. Take control of your money and your life today. Stay vigilant. Your balance depends on it. We've explored the surface, debt traps, hidden fees, and private equity looting. But to truly understand why the modern economy feels broken, we have to look at the master system behind it all: financialization. This is the story of how finance stopped being a tool and became the master. It started in the late 70s. A fundamental shift occurred where the primary goal of the corporation moved from serving stakeholders, workers, and customers to maximizing shareholder value at any cost. This was the birth of the extraction era. Finance was supposed to be the oil in the engine of the real economy. Instead, it became a siphon, pulling capital away from productive industries like manufacturing and research into the hands of the speculators. Today, the financial sector claims the highest share of corporate profits in history. It attracts the brightest minds with astronomical pay, but what are they building? Often, it's just more complex ways to move money around without creating anything new. Actual business investment has plummeted. In the 1960s, it was over 5% of GDP. Today, it barely hits 2.9%. Why build for the long term when you can extract for the short term? Private equity has perfected this model. They load companies with massive debt to fund their own buyouts, strip the company's assets, pay themselves huge fees, and leave the wreckage for everyone else. The human cost is staggering. Within the first 2 years of a PE takeover, job cuts average over 4%. Large bankruptcies are now overwhelmingly tied to these leveraged buyouts, devastating families and entire towns. Look at healthcare. Private equity has moved into hospitals and nursing homes, where the drive for profit often leads to higher mortality rates and slashed services. They turn our most essential needs into mere profit machines. Housing has met the same fate. Once the foundation of middle-class wealth, it's now a speculative asset for institutional investors, pricing out an entire generation and turning homes into lines on a ledger. One of the hidden costs is the brain drain. Our brightest engineers and scientists are being recruited into finance to build high-speed trading algorithms instead of solving the world's most pressing problems. Then there's the shadow banking sector, non-bank financial entities that operate with little oversight but massive leverage. They are the ticking time bombs of the next financial crisis, hidden in plain sight. Even the current AI boom is being financialized. AI hype drives 40% of GDP growth and 80% of stock gains, yet many of these companies have yet to show real productivity gains. It's another bubble in the making. This leads to a K-shaped recovery. The top 20% thrive as their assets balloon, while the rest of the world struggles with stagnant wages and $18 trillion in household debt. Inequality isn't a byproduct, it's a design feature. It's not just free market magic, it's a system of rigged incentives, tax loopholes, weak regulations, and a legal framework that rewards extraction over creation. The rules are written by the people who benefit most. But you can resist. It starts with awareness, but it moves to action. Diversify your investments away from Wall Street-heavy products. Support your local credit unions and community banks that actually reinvest in your area. We must push for systemic reforms, closing private equity tax loopholes, reinstating strong financial regulations, and demanding an economy that serves human needs, not just quarterly earnings. Build your own personal buffers. Focus on low-debt living and emergency funds to reduce your dependence on the financial system. Awareness is your first weapon, knowledge is your second. The great hijack only continues as long as we remain silent and complicit. It's time to stop feeding the beast and start building a real economy again. Take control today. The truth is your power.